Hello, I'm going to talk today about our guide to volume commitment telecom agreements and MARC contracts. So I'm Anders Nicholson, Managing Director over at Berlin Pacific, and this is about our how-to in-depth guide for contracts. This is for IT, procurement, legal departments, and this can also be relevant to other types of IT contracts, but really the focus here is on telecom contracts. So the reason why we created this guide, and we'll try to link to a blog copy of it, and you can also contact me and I'll send you over a PDF copy on LinkedIn. So we found that many clients have signed volume commitments, especially with companies like AT&T, where they have a minimum annual revenue commitment. And there are a lot of problems and pitfalls which clients don't see coming, and yet these problems are kind of inevitable given how vendors operate. So they can be very challenging to negotiate and manage to everyone's advantage, as one of our CIO clients pointed out. And so it's really easy to spend substantially more, say 10 to 20% more than you expected. And sometimes you can spend a lot more on average than you anticipated over the life of the contract. And this can wipe out a lot of the anticipated savings from a new contract. And by the time you realize it, there's usually a whole lot. There's usually not a whole lot you can do. So we're going to talk about some of the unpleasant and expensive surprises which might be in store and some of the things you can look out for. And we have a whole checklist at the bottom, which you can use as well to help you while you're going through these. And we're also, of course, available to advise you on any type of telecom contract. So we'd love to help with that. So order volume commitments. So basically they state you commit to spend X dollars per year for a certain number of years, maybe 3 years or something like that. A lot of telecom firms love 3-year agreements. And so the idea is that if you spend $100,000 over 3 years, but if you don't spend, say, that $100,000, you have to pay the difference. So and then in return, they give you the ability to buy all sorts of services at rates which they say are discounted. So one of the big benefits is that you will know what you have to spend, and you simply need to spend that amount on whatever services you like. And so the good thing is that this gives you a lot of flexibility to add and drop services, and you're locked into pricing that you currently like. So that part's definitely a positive. But here's some of the primary issues. So there are billing errors in telecom, and this isn't exactly news, but often the prices you are billed for won't be what you agreed to. So you definitely want to consider how can we shift the burden of vendors' potential future failure onto them and not onto your shoulders. So what often does surprise people, though, is that many vendors, they won't really accurately track your spending, and they won't really let you know if how well you're doing on making your commitments and doing it in a timely fashion. So this is called attainment. So unfortunately, they'll often let you know after the contract's over that you didn't meet your numbers, is basically what it is. So they won't regularly tell you if your spend is above or below your committed amount, and often they do have antiquated and disparate systems. And so this can lead to that unpleasant and costly surprise or overspending in order to avoid penalties, because you'll end up realizing like, oh, I thought I spent, well over $100,000, but now AT&T or whoever is coming back and letting me know, hey, you didn't spend all the money that you committed to. So now you have to cut a check for, 20 grand or, 10 or 20% of whatever it is you committed to make up the numbers. So it becomes a lose-lose situation for the buyer and win-win for the vendor. And the vendor wins because, you're going to pay them for the services you purchased, or you buy more services than you need to. And so it's a little bit like a salary cap, except you're in sports, except you're never meeting your targets. So give an example. One time a vendor cheerfully informed a client that they were $800,000 below their commitment in the first year, but not to worry because obviously the vendor's tracking of the client's spend was wrong, so the vendor wouldn't ask the client for $800,000. The vendor, however, didn't tell the client early on that the vendor's system reported they weren't spending enough, and the vendor didn't really take steps to determine what the true attainment was. And this was really bad for the client because they were left in the dark and they didn't know if the vendor would present them with a big bill for the missing attainment at some point in the future. So we've seen this for, $10,000 contracts, $1 million contracts, $100,000, whatever it is. And, AT&T will present you towards the end of your contract or after your contract a bill for a shortfall. And so in this guide, we've seen this a lot with AT&T. So we really, especially, so we use them as an example. So we have a couple examples in here. Maybe we'll go through one. So we had a company where they had a building supply company. They had an agreement with AT&T in place for their long distance provider. And AT&T claimed that the firm was 33% below their commitment for MARC attainment. And so the interesting thing, though, is that we knew that AT&T was actually a big vendor. The client was spending a lot of money with AT&T. So it turned out that AT&T was only counting some of the services being spent on towards the volume commitment contract. So, for example, this time the firm had a lot of data T1s, but for some reason, AT&T didn't think of spending on MIS as being part of the contract, and that wasn't obvious. We thought the wording did cover MIS, and the client had no idea because AT&T hadn't told them that there's no way they could ever actually achieve their commitment because AT&T wasn't counting all the AT&T revenue towards the contract. So fortunately, we were able to negotiate an agreement, which all the shortfall fees were waived, but AT&T used this as an excuse to make the client sign on for additional years with AT&T. But in this case, that was fine. The client was okay with that. But when we made sure that AT&T would count all the spending with AT&T as going towards the commitment. But unfortunately, even then, there were problems like processing paperwork and things like that. But at least there was an agreement in place, so we knew there wouldn't be an issue. So we can give another example of this in the guide. And so just go through some things here. So just when faced with a large bill for a shortfall, an AT&T client or other telecom client can be confused because the vendors never said anything about a shortfall and the total bills were above the commitment, usually well above the commitment level. And so you'll learn things that the vendor isn't counting things like as counting towards the commitment. So some things which might not count towards the commitment in our taxes, regulatory charges, and this could include dodgy surcharges and pass-throughs. It can include pot lines, MIS internet services, PRIs, and voice T1s. And bills, which, just they have AT&T's name on them. So you would assume they would count, right? And then it could also include services that AT&T was supposed to install, but never did successfully install. And this means that you weren't able to, use the services. It didn't make sense for you to be charged for them, but, you can't actually, but you were planning on buying these services and that would count towards your commitment. But because AT&T never did their side, they now want to be paid for services they were never able to install, which doesn't make any sense. And sometimes there'll even be services which seem to be clearly listed on the contract, but AT&T won't count them towards your attainment numbers. And, in my opinion, these are sometimes AT&T's fault. And sometimes it can be someone else's fault. And it can be to kind of a lack of clarity, and which I think is also, at the end of the day, it's the vendor's fault. So the problem is that, after learning these facts, you now have to spend valuable time fighting with your vendor, like AT&T or Verizon, or you have to use us to handle a problem that shouldn't have occurred in the first place, which is why we wrote this guide. So in some cases, the contract is such that the client is completely defenseless, even though they followed the spirit of the agreement, and they have to pay in more money, which is not a lot of fun. So there are some things you can do to help protect yourself. This guide can help. We can help negotiate contracts. We can bring in lawyers as well, and lawyers can also use this guide to help them create an iron contract. So here's some kind of key things to know. You have no rights that aren't listed in the contract. You definitely want to educate yourself into the contract. So I recommend that you make sure that AT&T spells out what counts towards the mark and which parts of which bills. It's good for them to say that it, in addition to the general language, just say, hey, AT&T, can you confirm in writing that these following things do count, these bills, these services, and the devil is famously in the details, so it's good to get the details in writing. So be very clear, get in writing what does count and is included in the annual volume commitment, and the interpretation will be in their favor, so it's really best to spell it out. So we spell it out further here. You can be very specific. On Bill A, sections X, Y, and Z count toward your commitment. Sections UV do not count and but must be paid for. If there are any other sections, you don't have to pay them, etc. So you want to, get really specific, is really helpful. So we go into those details here in this guide. And so, just please keep in mind that we have seen AT&T send surprise bills for over $1 million to sophisticated buyers because the buyers didn't make sure AT&T spelled out what spending counted toward meeting the commitment. And your account representative will have a little say in the matter. This is because companies have a separate department, which isn't related to sales, and they're in charge of making sure that clients meet their commitments and that the vendor gets all their money. So they're going to be very rigorous and forceful, and they're going to do what's in the best interests of the organization in terms of just collecting the money. Not they don't really care about the relationship. So one of the next big points is attainment reporting. So you want to, you don't really want them to watch their own hen house, as it were. So you have to look at what kind of reporting on attainment do you want? How often, what format? You want to make sure that they're committing to give you reporting from the get-go, not just at the end of the contract when it's too late to do anything about it. So you really should tell the carrier, hey, we really want this, and they'll tell you what they can do, but you really want to figure out what you can live with and get real specific details. And then you also want to know, how will we be protected if you don't get a spreadsheet every month or whatever, kind of report you need. There should be, I think, a commitment that any shortfalls in any particular month where AT&T didn't give good reporting, that those shortfalls shouldn't count. And you should be treated as if you have met your attainment. So definitely get them to put everything in writing and, make it clear you want to pay what you owe, but you don't want to find out later that you owe more. I think that's a fair way of putting it, and people can respect that and go back to the boss and say, hey, we need some sort of commitments here, and you can kind of escalate that. And I think it's comes as fair, especially when you're in negotiations with a company who wants to do business with you. So generally, so that's one of the things you want to watch out for. How long it takes for them to show you bills and things like that, and also correct bills. Another interesting thing to note is that vendors often have clauses that offer credit to their customers for billing errors that only go back 6 months. So, why shouldn't this be reciprocal for commitment shortfalls? If they don't notify you about shortfalls in a timely fashion, you shouldn't have to pay them either, just like you have to tell them about billing errors in a timely fashion. So make it reciprocal. That can also minimize the damage as well. But, I personally think it's their job to tell you in a timely and error-free manner what you owe. And I think you're always right since you're the customer. And I think that they should, be given time limits on how long they have to notify you about shortfalls. So another thing to notice is, and keep in mind, is SLAs. And so there are definitely technical SLAs, which are important to think about. One other thing we'd like to recommend is that you should have plans in place for handling continued and repeated failures. and you should be able to implement them quickly. So this means moving off all your traffic off to another vendor. So I think it's important to have an SLA where you can exit some or all of your services if there are multiple impactful failures that occur, even with just one service. And I think that your volume commitment needs to decline, and I think to $0 if possible, as you cancel services due to SLA violations. I think that's really important to keep in mind. If they can't deliver a good service and you have good reasons to leave, you should be able to leave and not have to face early termination charges or volume commitment um, shortfalls. And also similarly, you shouldn't have to pay termination fees anyway, but if there are other circumstances in which maybe it's fair to pay termination fees, you definitely want to make sure that also counts towards your volume commitment and counts as revenue to AT&T. So, you might have SLAs that allow companies to deliver com to get terrible service, but it's so often that you might notice a service, but it doesn't really violate the SLA. So you really have to look out for that and really think that through and make sure that repeated outages, which drive your users crazy, really are grounds for you getting rid of that service and replacing it with a vendor who can actually do a good job. Often that's not a problem, but if it is a problem, it's a really horrible problem. So you want to make sure you're protected, and honestly, the vendor shouldn't have a big problem with this because they should be able to deliver a good service, because that's they normally do that, and there's no reason why you should be expected to pay for it if they don't. So you want to really clearly define what needs to be measured and really think that through, and really make sure that the vendor is being responsible and can't point fingers at third parties. So, and that includes things like compatibility issues, et cetera. So here are some other checklists around SLAs as well. Does it address things like customer care, customer service response times, resolution timeframes, bill accuracy, remediation, attainment? So I think that the attainment reporting should be part of the SLA, and if they fail on that, there should be some sort of penalties for that. If nothing else, you don't have to pay for attainment shortfalls. Maybe even your attainment is for a month where they don't do good reporting, the amount of revenue you is reported is essentially doubled. So it kind of maybe even makes up for months where you don't make where there's a shortfall. So you want to have a good escalation path as well, and that as we said, if you drop a service due to performance issues, your volume commitment must also drop, and there shouldn't be any raising of prices on other services. And if for some reason one service stops working, but this means that other services now are useless or unhelpful, then you need to be able to cancel all the services, and all your commitments must drop as well, and you shouldn't see increases in pricing on those things you are kind enough to keep with the vendor. So hopefully that all makes sense. Definitely get a copy of this guide, and it goes into detail, and you can have like a written thing you can study and create your own checklists, and we'll have a checklist down here at the bottom. We'll show you. So this section here, we're not talking about marks, but just about how you work together, and this is part and parcel of a volume commitment contract. So you really want to make sure you get a good sense of who you're working with, and really understand who's going to be there to help you when the account manager is done signing the deal. So you want to have an escalation path. You want to have people you can talk to besides just calling a phone number to get service. So if in case you have an issue. Now, that said, often account managers will be helpful and they will try to do what they can to make you happy. But to be frank, it's often not really their job. They're really sales reps, and they're just there to get clients to sign new pieces of paperwork. So getting that addressed ahead of time, like, what's an escalation path? Multiple people you can talk to, multiple executives. Probably want to keep that list updated every few months, just in case some of the people leave. You could have like a regular account reviews with vendors and things like that. That can also be very helpful, and that includes making sure that moves, adds, and changes are being tracked. That they're kind of on top of things. I would recommend doing that. Same thing with the attainment tracking, as we were saying. And, also you could look into, billing in general. How is billing going to be delivered in a way that helps you, and you could ensure that the great contract you negotiated is actually being implemented into the bill, and those good prices are actually reflected in the billing line items in your large bills. Because as we know in telecom, a lot of these bills can be quite large. You can spend thousands and tens of thousands just in one bill, and you can have a lot of these bills. So I definitely recommend people look into that. And also you want to make sure that, if there are billing errors and you get credits, you want to make sure that's not deducted from your attainment. It's their fault for the billing errors. So them charging you in the first place, they should be counting that as part of your attainment. And you shouldn't have to suffer. So here's some other potential items in a contract. You could look out for discount-only contracts. You want to make sure that the underlying prices are agreed to and locked in. So let's say they could say, oh yeah, you get a 20% discount on, all of these MPLS ports. Well, you want to have in writing what's the price of the pre-discount price of those MPLS ports, and make sure that's in writing. And of course, also to whatever degree negotiate those. But you don't want to find out later that they show you a living document which has changed since you signed your contract, and something which was $1,000 a month is now $1,500 a month because of inflation. You want to make sure your prices are locked in, and then that we continue to go into that here in the document. So you have things like vendors will literally write, they reserve the right to increase or decrease monthly recurring charges at least 30 days notice, and other rates at any times. So that's not helpful at all. You don't want to permit any kinds of changes to the discount rates or the underlying prices. And actually, I think it should be locked in to go that when your contract should go month to month at the end of the year, or at the end of the final year of the contract, should then go month to month, and then all those prices should be locked in. And you should have options to continue paying those prices for infinity, or at least many years in the future. And then similarly, you want to have a copy of all the terms and conditions. You want to make sure those are locked in, and you want to store a copy of that, because sometimes vendors will have terms and conditions which are online, and it's just a living document. And we objected to how one of our clients was being billed, and I don't know if it's a coincidence. I doubt it, but it is a large vendor, so it's possible it's a coincidence. But after we objected to how our client was being billed, they went in and changed the terms and conditions. And so that what the telecom vendor was doing was okay, and in line with the terms and conditions, even though they weren't earlier. So definitely make sure you have an archived copy of that, and it's locked in. And I would have the vendor sort of submit something in writing with your agreement. So another big thing we can definitely recommend is looking out for regulatory charges and surcharges, but I recommend that you don't just accept whatever they put on the bill. Get them to tell you ahead of time what those charges will be, and whether or not they will count towards your minimum annual revenue commitment. And so if you should also have them say in writing that if they can't explain them, and don't tell you about them in advance, then you don't have to pay them. So make sure that's in the contract. And unfortunately, there's language in a lot of carrier contracts where they can just make up anything they want down the road, and this will definitely pad your bill. And unfortunately, what appear to be regulatory charges do, in a convoluted way, they do go towards the vendors basically keep that money. They have a way to keep that money and use it to fund their operations. So you want to make sure that they're very clear on what they can add, and that it's not arbitrary. And I recommend you only pay the surcharges you're obligated to pay, and then they can figure it out for themselves. The vendors can figure it out for themselves. So you definitely want to also know how the charges are computed as well. So things like UCC or USF, if you are going to pay them, and you have to feel like you have to pay them, then you at least need to know how they're going to be calculated. And I would recommend that they have to give an explanation showing that they actually have calculated them correctly. So sometimes carriers, we've seen this is crazy to me, but a carrier even calculated taxes and surcharges based on the pre-discounted pricing and the pre-credit pricing, which is kind of like saying, hey, I sold you something for $50, but the original sticker price was $100, so I'm going to charge sales tax on $100. It doesn't really make any sense. So you need to look out for that. So similar as we said, make sure you're not responsible for MARC penalties or charges if AT&T or any other carrier doesn't install the service or doesn't install it on time. You want to make sure that they only start billing you when the service is actually fully activated and working. And similarly, there's some sort of outage, you shouldn't have to pay for the service. Another big thing for flexibility is, let's say you're anticipating spending like $500,000 over the term of the contract. Try to negotiate for, a $300,000 commitment. And this way it's going to be really hard for you to miss the targets. And it'll give you like a lot of flexibility. So that will be really helpful because, things can change over the next few years. And also too, you don't want them coming back and billing you for missing anything, any commitments whatsoever. So another thing you could do is, if it's a commitment for 3 years and, $3 million, well, why don't you tell them like, well, just in case, let's change the wording of the contract so that, yeah, it's a 3-year contract, but we actually have 5 years to do it and spending is cumulative. So, if we somehow, knock off all of our numbers and, make all of our commitments and let's say just say 1 year at the beginning or the end of the contract, then we're off the hook for the full 5 years. So that can help a lot. And then just in case too, depending on some of the technology you have, if your vendor, the carrier decides, hey, this is obsolete technology, we're getting rid of it, and they make that announcement, partway through your contract, and you don't really want to use the replacement, then your commitment should then be scaled back to reflect the fact that they're not selling you all the things you thought they were going to be able to sell you. And similarly, they shouldn't be allowed to force upgrades to new service and then similarly, like what happens if there's an acquisition or they divest part of their business. That I think that's important. There shouldn't be penalties for disputes. That's another important thing. And also late payments. So look into construction fees, things like that. That's usually not an issue, but in some cases that can be. Also, you could look into whether or not you're part of another entity or sister company or parent company, and you could see if you could somehow get on their agreements. Maybe they've already negotiated something good, or maybe you guys can, as a whole, all your spending can kind of help meet commitments. So another big one too is look out for the renewal clauses. And they like to have automatic renewal clauses, so it will be another year. It'll just go 1 year after another, maybe even multiple years after another. So I don't like automatic renewal. I think that it's good to, although I suppose if they get rid of early termination charges, once the initial term is complete, I think that then it's maybe not so bad. But I would definitely prefer month to month and then no termination charges for anything you decide to get rid of. And then, if you think prices are going to be falling, then in certain areas, and you could even have benchmark clauses so that you can negotiate down the prices of things which have gone down in price without seeing an uptick in things which have gone up in price. Similarly, there might be business downturn language, if something happened to your business and you guys have to scale back locations, gotta look into that. So I have another case study in here with the client. That's one of the things happened to them. So it's good to look at into. I also recommend, you definitely want the vendor to explain how the contract protects your interests and revise the contract to meet your requirements. And so they can insert correct language, but it can be good to have your lawyer write portions of it, or having a lawyer review any final agreement is a good idea. And, we can help manage these negotiations as well, go through these details, and also refer appropriate legal counsel. And so is one of our CIO clients said, I would stress the need for help in negotiating such large and complex contracts. So it's so let's see. Then we talk about prior preparation for contracts in general. And, so it's definitely good to shop around, get a sense of different providers and their agreements. And so I think that's very helpful. And a lot of, everything's negotiable. So, might not always be true, but I think you should go in believing it's true. And it definitely never hurts to ask. So definitely really understand what the options are, and things can be negotiated. And you do want the contract to be like a win-win, and you do want to work with somebody where it does feel like a win-win, where they're going to be giving good service. So in conclusion, make it a partnership and not a competition. Have a strong relationship with your vendor. This is very important and helpful in complex and large MARC arrangements. You both want the same thing to succeed. So be prepared to get help. These contracts are not easy and can be very expensive. A lawyer can help. Firms like Berlin Pacific can help, and prospective vendors can help if you're alert and ask the right questions, and the account rep gets the right people involved from his organization. So, but I don't recommend going alone with complex and large value contracts. It's good to get a second set of eyes, but we have written this guide, which I think will help forestall a lot of the problems. So we have here a whole checklist. So we explain, like, these are all the different things you should look out for. So if you've kind of, consistently made sure you've gone through all these, you should be in good shape. So yeah, please feel free to reach out to us for a PDF copy. I'm Anders Mikkelsen with Berlin Pacific. I'm on LinkedIn. I'll try to post a link to this, to a blog article, which goes over a lot of this on our website. And feel free to reach out to Berlin Pacific if this could be helpful to you. What else would we like you to know? Well, we help firms in general with complex billing. Telecom's a good example of that. We typically find companies with $100,000 in annual spending to millions of dollars in annual spending. We could typically save them 50% of their telecom spending without having to change vendors. And we can do this because there's a lot of complexity. We come in and we don't just give recommendations, but we also implement cost savings proposals for you. And we find that we can save you 50% of your budget by getting rid of billing errors, getting rid of unused services, right sizing underused services, and helping you get better pricing on everything that's left over. And we have ways to do that while you're under contract, as well as helping you negotiate at the end of your contract. So love to help. Please reach out to me, Anders Mikkelsen at Berlin Pacific, and please leave a comment, and look forward to talking to you on LinkedIn or as well as in the comments. Take care.